I think when gold prices were at their peak, there was an expectation, or at least a presumption, that gold producers were making huge margins. And I think that was wrong, because the rate of growth of costs was much greater than the increase in the gold price. So the key issue was, what kind of margins did companies have? When gold prices are high, there was less emphasis placed on cutting back costs, and therefore the margins weren't great, but people didn't pay much attention. As the gold price softened, all of the good gold producers clearly focused on things that they can't control. They can't control the price of gold, but they can control their costs. They can control costs of consumables. They can work with the manufacturers and the producers of vehicles and other mechanical and electronic equipment to try and cut their costs. They can be more efficient in their mining practices. There are many ways that they can do better. Now, should they have done this sooner? Hindsight is 20/20, and you can argue that they should have been, even at high gold prices, been focusing on this. They didn't. So currently you see a lot of companies having to write off some of their reserves because they're uneconomic at $1,200 gold. They have had to cut back production of marginal grades, so they're focusing on higher grades, and they are cutting back on some of the marginal deposits that they mine. So it's been a very difficult situation for the mining community, gold mining community, to face. But the many companies have made progress. They've become leaner. They focused on higher grade products, and I think the move to what's known as all-in sustaining cost calculations that the World Gold Council has championed has really put much more focus on how companies evaluated their cost of the total cost of mining and production, and that's been a very important discipline. But I suppose in life, until you reach a crisis, you don't find the optimal solutions. But now, while the market capitalization of many gold companies has fallen to a fraction of what it used to be, this has forced discipline on them, programs of continuous improvement, and divestiture of less profitable operations, focusing more on perhaps acquisitions of brownfields, and maintaining, in some cases, very strong exploration activity, because mining is a destructive business. As you produce gold, you need to find more deposits, or eventually you can mine out all of your deposits and go out of business. As you know, Kinross is the only publicly traded Western company to actively mine gold in Russia, or any hard rock minerals for that matter. We have been monitoring very closely sanctions back from March the 4th of last year, when Canada announced its first sanctions. I think this is a lesson for any mining company or any company doing business in Russia, the necessity to examine very thoroughly what the sanctions actually say. Unfortunately, there's a lot of panic in the market. Companies, consultants don't really bother to read carefully, in all cases, the wording of the sanctions. So panic leads to self-sanctioning. So we have seen some counterparties, we have seen reports. I have received questions in my capacity as chair of the National Board of Directors of the Canada-Eurasia-Russia Business Association, companies asking me and my colleagues, does this mean I have to stop doing business with Russia? And so the number one lesson is to carefully examine what the sanctions actually say. Number two lesson that we have applied, and other companies are doing as well, is to evaluate where we actually procure from, which countries, whether it's Canada, the US, European countries, and to see where there may be some alternatives for supply. That's not, the intention isn't to sidestep sanctions. The intention is to maintain production, because we have an obligation to our employees and our shareholders to do that if at all possible. As you are aware, sanctions from Europe and North America have hit the oil industry very hard, particularly deep drilling, deep offshore drilling, and Arctic programs have been virtually stopped because those companies involved from the West were obliged to stop. There are no sanctions specifically targeting hard rock mining, for which we're grateful, obviously. But in the past year, we have worked very, very closely and intently to find alternative supplies. We find that a great percentage, almost all of what we purchase in North America should, and I stress, should it be sanctioned by Western countries, we have opportunities to procure similar products and services elsewhere. So I think the lesson for everybody in sanctions, at least the sanctions applied against Russia, is that do your homework, be thorough, bring in the specialists, outside legal counsel, and others who can help you to streamline your procurement so that you can bring the necessary inputs to do your business. And we have not been affected, our production and our operations have not been affected by sanctions, and we obviously hope that that continues. As concerns Russian sanctions against imports of certain food products, I think that has hurt some producers. The pork producers in Canada in particular are very heavily affected. Canada was exporting in 2013 roughly $400 to $500 million a year of pork products, and that's now stopped virtually to zero. Some exports have gone to neighboring countries, but that's a big blow to small pork farmers in many parts of Canada. As a consumer in Russia, I can say that there are alternatives, and if this eventually leads to Russia diversifying its manufacturing of domestic processed food products, that's a good thing. But they should have been doing that anyway, even while they were importing cheese from France or other products. So I think sanctions, my personal view is sanctions are not good whenever they're applied against whomever they're applied. They usually do not address the issue that is the focus of the reasons why sanctions have been imposed, and ultimately everybody loses. A lot of companies obviously feel that that's necessary. It's necessary to cut, as I implied in I basically stated in my first couple of responses. When margins are squeezed, then those deposits or those ore bodies that might have made some money at $1,600 gold may not be at all profitable at $1,200 gold. Therefore, they have to be written off the books because there's no reasonable opportunity to earn money, so they get moved from proven to different categories, which hurts the balance sheet. By the same token, the marginal costs that you face in such ore bodies or mines need to be stopped, and to focus on where you can get the most profit and where you can do the most cost-effective mining. So that and for future growth, some of the expenses that might have gone to those types of activities could go to exploration for the medium to long-term future of a mining company. So it's inevitable. There's no way around it. Companies decide to do this at different stages. Some early on in the perceived crisis. Others take much longer. But everybody's involved, from shareholders down to the actual miners and the workers at the site. People have to be more efficient. They have to work more smartly, as the cliche goes. Instead of buying replacement vehicles, they have to make sure that the maintenance programs are done correctly in order for vehicles not to break down, so you can get more hours of service. Even down to the mining technology. I'm not myself a mining engineer, but I do know that how you drill and dig and blast for ounces of gold is critical, so that you can no longer be general in your approach. You have to be focused and specific and do only that work which will yield the highest grade ounces in your operations. If you have that ability to do that, most companies will. And we've seen the very large miners also sell marginal mines, or mines that are geographically remote, or mines that could perhaps be more inexpensively mined by smaller companies or by companies that have a geographic focus in that part of the world. So big is not necessarily beautiful, but maximizing the margins on every ounce of gold that you produce is the way for the company to stay in business, while at the same time being on the lookout for brownfield expansion, for acquisitions, for mergers, in order to keep going. Because, as I said before, if you can't do that and you're not making money on your current operations, and whatever reserves and resources you have at a low level of the gold price, if you can't make money on them, the ore will stay in the ground. Traditionally, investors, whether institutional or individual investors, that wanted to have exposure to gold, because gold has always been known as a safe haven against inflation, against currency fluctuations, and they've in past been able to either own physical gold, or they've been buying equities in gold miners as a proxy for exposure to gold. You might argue that if you own the physical gold, all the risks of production have already been priced into the product. That's true. Always a mining company has challenges that are unrelated to the final price of the gold. We talked about fuel costs. We talked labor costs up until 2014 were a huge problem, a scarcity of skilled labor virtually in every part of the world. So you could argue that if you're an investor, why would you want these additional risks? About 8 or 9 years ago, the World Gold Council gave its blessing to the creation of what are known as exchange-traded funds, ETFs, which allowed a pool of investors under these funds to gain direct access to actual mined gold as a mutual investment. And what we saw in the subsequent years is a huge rush, particularly by hedge funds, by institutional investors, that perhaps thought that investing in mining equities, gold mining equities, was more risky than purchasing actual gold as part of a mutual fund. And what that did is it took away a whole demographic of potential investors in gold equities. And in my personal opinion, that has contributed to the lack of, or the loss of, degradation of confidence in investing in gold mining companies. So you see a huge softening of the capitalization in many companies. So if you look at today, some big producers, multi-million ounce producers, are worth maybe a third of what they were 3 or 4 years ago. So there is an argument to be made that an investor would have an opportunity to come at the ground floor, so to speak, because as gold becomes more expensive, the equities will also appreciate. And many of these companies, despite their production and market cap, continue to pay dividends. If you own physical gold, you don't get dividends. You only make money if you sell the gold. But a good, efficient gold miner who's able to pay dividends will give you a stream of income and potential upside as gold prices improve, and as the efficiency of mining increases those margins and makes the balance sheet of these mining companies much more healthy. So then the market will reward that kind of efficient mining, and the value of the equities will also grow. That doesn't mean that you somehow strip out the risks of production or the risks of increasing in other commodities like the oil price. That's still an issue. So if you really want to be safe and you don't want any income stream owning physical gold, either directly or through an exchange-traded fund, For a more casual investor, it might be sufficient. But obviously, working for a public gold mining company, I think there's a lot of value in investing in gold equities. And our company has done very, very well in the last 2.5 years to bring down our costs, to become more efficient, to improve our balance sheet, which is very, very healthy. We're a low indebted mining company with some very strong performing regions, and there are other companies like that out in the market for investors to choose from.